Ladies and gentlemen, my name is Mohammed Khanna, and it's a real pleasure to welcome you today to the webinar of our MIC Tax and Technology Services team. Our team includes my partners, Shital Soni and Pratik Toshniwal, and is chaired by Munir Dwaidi, with Ala Khanna as board advisor. Our team of very experienced professionals also includes Shadi Abdullah, Shadi El Mkhallalati, Karishma Suwarnakar, Doha Harb, and Lara Musawi. We all look forward to accompanying you in this new age for the United Arab Emirates. Indeed, on 9 December 2022, Federal Decree-Law No. 47 was published in relation to the taxation of corporations and businesses. Although we want to help you as much as possible through your journey, we, however, want to remind you that the Ministry of Finance and the Federal Tax Authority are the only official sources of information on federal taxes in the UAE. Having said that, we are here to simplify the law for your better understanding, and we, at the management level, are fully involved in this process as well. I will now leave the floor to Munir and Ala to say a few words.
Good afternoon, ladies and gentlemen. Thank you for taking the time to join us tonight. As chairman of MIC Tax and Technology Services, it is my great pleasure to welcome you to our webinar on taxation in the UAE. It is intended to be a prelude to the imminent transition from no tax jurisdiction to a corporate tax jurisdiction. So let this webinar and the following ones over the next few years be an eye-opener to the multitude of transformational issues which are likely to be faced by individuals and various types of businesses operating in the UAE to comply with the new tax regulations. MIC Tax and Technology Services consists of a highly qualified and experienced team of experts who have decades of experience within the tax administration and can help you navigate through the upcoming challenges and help you get ready to undergo this transition. As ministerial decisions are being issued piecemeal, capturing all the tax regulations may be quite tricky and may require considerable diligence and commitment from the side of the taxpayer to be well prepared and informed ahead of time to avoid falling into the pitfalls of taxation. MIC Tax and Technology Services can be your partner and tax advisor to provide you with guidance and solutions pointing to the latest updates and developments in the regulations and to assist you in covering and highlighting the various complexities of the new tax law. The primary objective of this webinar is to start by stirring your curiosity to learn more about the multitude of rules and issues that will impact your current status. Our aim is to trigger your attention to the steps and measures needed to start undergoing proper tax planning and simultaneously implementing necessary upgrades to your existing IT and ERP systems. So it is not only about understanding the new tax law, but also going further into preparing your organization to accommodate technology and accounting upgrades and all other transformational changes, which you will no doubt find to be unavoidable. Therefore, I now strongly recommend that in addition to understanding the new tax law and its implications, that UAE businesses should focus on the following two primary and necessary measures. First, the needed IT modifications to the existing systems and processes to ensure an efficient interaction between technology and tax. And second, the needed ERP upgrades to the existing accounting systems, charts of accounts, financial statements, tax modified P&Ls, and the applicability of accounting methods and FIRSs to be able to handle new tax rules and regulations. MIC Tax and Technology Services can be your ideal one-stop shop to provide you with this bouquet of these interrelated expert services, acting as your corporate tax advisor and simultaneously as your ERP, IT, and cybersecurity consultant to bring you added value and help you organize your systems and processes over the coming periods. So stay tuned throughout the upcoming interventions by the different experts of our team and hope you will enjoy and benefit.
So maybe I'll start with the overview of taxation.
Great.
Well, good afternoon, everyone. One of my friends, a relatively mature friend, once shared his wisdom with me. He said, normally a person spends half his life making it complex and rest half struggling to make it simple. Like in first half, we fall in love, we marry, blah, blah. And the rest half of life, we meditate, do yoga, etc. I'm sure you feel the same while dealing with the lawyers and tax professionals. More so with lawyers though. I'm sure you have experienced that when you sit with them, even once upon a time, seemingly simple things probably start sounding terribly complex. Don't worry, we are today, we'll try to complexify the simplicity. Sorry for this. Simplify the complexity here for you. I'm truly glad to be in front of 200 odd people here today, curious to learn. Karishma, can you go to the next slide? Curious to learn about taxation, or rather planning for ways to learn some little tricks about optimizing their potential tax liability. Wondering what the meditation yoga gurus would be doing today. We tax professionals seems to be giving tough competition to them, at least for the time being. Well, my colleagues will walk you through in detail with all the major provisions of tax law. I wish to highlight here some salient features. First and foremost, as the name suggests, it is the tax on corporates, not on individuals. No taxation, no taxation on personal investment income, which is i.e. rental income, dividends, income from debts and equity securities. Also, no taxation on salaries and wages. Tax rate has been kept at 9%. However, for incomes up to 375, for net profit up to 375, the tax rate is 0%. Good news for SMEs or micro SMEs, there is something called small business relief. For SMEs having turnover of up to 83 million dirhams, wherein the tax liability will be automatically assumed to be nil. If you are dealing with foreign suppliers / service providers, again good news. For the time being, withholding tax has been kept at 0%. So no need to worry about deducting the tax here as we see in other jurisdictions. There are provisions for tax grouping, carry forward of losses, etc. based on internationally accepted tax principles. The law will be effective in just 6 days from today, i.e. 1st of June 2023, and applicable for financial years starting on or after 1st June 2023. My colleagues will cover in detail about return filing due dates based on different accounting periods. It is important to note that global income is taxable for UAE resident persons / mainland entities. Of course, subject to certain exemptions, relief, deductions for foreign taxes that is paid. And finally, special concessions are provided for qualifying free zone entities, subject to satisfaction of certain conditions. We're still awaiting, as Mr. Munir mentioned, ministerial decisions are coming in piecemeals, and we are still awaiting certain key important ministerial decisions on this front. Karishma, if you can go to the next slide. I thought you might find this slide interesting. We have looked into tax rates of about 140 countries. And guess what? UAE tax rate of 9% stands amongst the lowest globally. And Karishma, if you go to the next slide, some of you who might be curious to know which all jurisdictions are still tax-free, here you go. Cayman, Seychelles, etc. that you see on the slide, around 8 to 10 jurisdictions still continues to be tax havens. Probably some of you will start looking on how to register entities in these jurisdictions. Well, that's all from my side. Thank you very much. I wanted to present the broad overview covering salient features of UAE Corporate Tax Law. And I hope you find this useful in the context of global tax rates that we have presented. I now hand over to my colleague Shadi to walk you through certain important key topics of the law. Over to you, Shadi.
Thank you, Shitan. So my name is Shadi, and today I'll be going over the application of the corporate tax. Who are the taxable persons? Who is exempted from this corporate tax law? And we'll be doing a small explanation about the small business relief available to businesses. So as an introduction, I just want to say that by the issuance of the corporate tax law, the tax system in the UAE has become committed to the international standards and is in line with the standards recognized by the OECD. So this is a major step and a very important one. In this slide that you are seeing, it shows you some examples of the tax periods and when you should start filing for taxes. So the corporate tax law is effective for financial years starting on or after the 1st of June 2023. For examples, as you can see on the slide, a business that has a financial year starting on the 1st of July 2023 and ending on the 30th of June 2024 will become subject to the UAE corporate tax law from the 1st of July of 2023 to the 30th of June 2024. In the second example, there's a business that had a financial year starting on the 1st of January, which is before the effectiveness of the tax corporate law, and is ending on the 31st of December 2023. This company will become subject to the corporate tax law from the 1st of January next year, so 2024. And this slide also shows you that corporate tax returns must be filled, payment must be made within 9 months of the tax period. So we have applied some filling dates and payment due dates as examples for you. Next slide, please. So the definition of a corporate tax. What is a corporate tax? A corporate tax is a form of a direct tax levied on the net income of corporations or business profits. It differs completely from the VAT tax, which is an indirect tax, also referred as a consumption tax, where the customer acts as a mediator between the companies and the state. For the corporate income tax, the taxpayer is the concerned and responsible person, while VAT, the taxpayer, as we said, is the mediator. The corporate tax must be applied alongside all other kinds of taxes. Next slide, please.
Yeah, Shadi, just wanted to highlight that if anybody wants to have any questions, please feel free to write in Q&A box. And we will take the Q&As towards the end of the session. And during the course of the session, we will be taking certain poll questions to make it interactive. So just wanted to pass that message. Please continue, Shadi.
Thank you. So let's talk about the application of tax. The applicable basis of taxation depends on the classification of the taxable person. So either he's a resident person, which is taxed on the income derived from both domestic and foreign sources. And there's the non-resident person, which will be taxed only on the income derived from sources within the UAE. For example, we have the taxable person as a juridical person. And we can define a juridical person as an entity that has a separate legal personality, so separate from its owners and directors, and is established or recognized under the laws and regulations of the UAE. Foreign companies and other juridical persons will not be subject to the UAE corporate tax law unless the foreign juridical person is effectively managed and controlled within the UAE and is treated as a resident entity. Foreign entities that operate within the UAE through a permanent establishment or that are considered resident in the UAE for corporate tax law purposes will be subject to the corporate tax law. We have also the taxable persons in terms of natural persons, which in corporate tax law means an individual or a person who can form a sole proprietorship or a civil company. And all income that is derived from conducting the business or business activity is taxable. All this income is taxable. For a natural person, one corporate tax file will be returned, which covers all of his business activities. We also have the taxable person, non-resident juridical persons, which are foreign entities that operate within the UAE through a permanent establishment or that are considered residents in the UAE for corporate tax purposes. These will be subject to the corporate tax. If the foreign entity earned sources within the UAE only, this would not trigger corporate tax payable or require the foreign entity to register and file for UAE corporate tax. Another thing about foreign jurisdictional person is that he may be treated as a UAE resident for corporate tax purposes and subject to UAE corporate tax on its income sourced from both UAE and abroad if it's effectively managed and controlled within the UAE. And generally, a foreign person will have a permanent establishment in the UAE if it has a fixed or permanent place in the UAE through which the business of the foreign person is carried on, or there is a person who has and habitually exercises an authority to conduct the business within the UAE on behalf of the foreign person. So this slide gives you a small example. If we can and here we can see the rate, the corporate tax rate, and you can see not only the UAE is among the lowest rates of tax, but it only applies to incomes up that are over 375,000 dirham. Anything below that is not taxable and is zero tax. Next slide, please. So who are the exempted persons? Who does the law not apply to? Any government entity or a government-controlled entity. You have qualifying public benefit entities, you have investment funds, any public pensions or social security funds, or anything related to private pensions are exempted from this law. And this slide also explains who are exempted or who can be determined as an exempt case. Next slide, please. So here we see that below the title of this slide, you have the Cabinet Decision 49/2023, and we intendedly put this here just to show you that decisions are coming in every day. So we will be updating our info, and if you have any questions about the new Cabinet decisions that are coming up, you can always get in reach with us, and we will update you with these new Cabinet decisions. So the business activities in the UAE that the turnover exceeds 1 million dirham, excluding wages or personal investment income or real estate investment income, or if there's no business not required to register in the file in the corporate tax return. Now, if there's here another ministerial decision, and it's a small business relief. So the UAE allowed small businesses to apply for small business relief program. An entity does not become automatically applicable to have the small business relief. The entity has to actually go and apply for it, and the revenue must be below 3 million dirham. Next slide, please. So that was my presentation. I hope you enjoyed. Now I will be transferring the floor to my colleague, Toha. Thank you.
Thank you, Shaji. Hello, everybody. Today, I will be covering the following topics: taxable income, exempt income, expenditure deductible and non-deductible, and how to calculate the amount of you. I will start by talking about the taxable income. The taxable income is the income earned by a taxable person and calculated on a self-assessment basis, and in which is declared to the Federal Tax Authority in an annual tax return. The source of the taxable income is the accounting net income as stated in the financial statement and calculated in accordance with IFRS for all taxable persons, except for SME with revenue exceeds 50 million AED. The taxable person may prepare his financial statement using the accrual basis or the cash basis. The cash basis method is allowed only if the revenue does not exceed 3 million AED, and a written application to FTA should be submitted. A taxable person can switch from cash basis to accrual basis using a written application to the competent authority. How to calculate the taxable income? To calculate the taxable income, certain adjustments must be made on the accounting net income in terms of deduction, like exempt income, and of addition, like expenditure non-deductible. As you can see on the slide, there are 8 adjustments that are outlined in the law. Sure, many regulations will be issued later on to clarify and to add to these adjustments. First adjustment, we have the unrealized gain and loss. A taxable person who prepares his financial statement on accrual basis, so where fair value and impairment value are recognized, can make an election on how to adjust unrealized results. So option 1, unrealized gain and losses on assets and liabilities are not recognized in the taxable income until they are realized. Option 2, unrealized gain or losses on assets and liabilities held on capital are not recognized in the taxable income until they are realized. On the other hand, unrealized gain and losses on assets and liabilities held on revenue continue to be included in taxable income. The fourth adjustment, the deduction that are not allowable for tax purposes. This also will be discussed in detail shortly. Transaction with related parties. Adjustment regarding related parties transaction can be made by the taxable person himself or by the FTA. To consider companies as related parties, they have to own 50% ownership or more, directly or indirectly, in a juridical person. Any transaction between related parties should be done using the arm's length to determine an appropriate transfer price. There are several arm's length methods that can be used to determine taxable income, like resale price method, cost plus methods. We will see them in details with my colleague Shad. We have also the any incentive or special relief, the tax losses. The amount of tax loss used to reduce the taxable income for any subsequent tax period cannot exceed 75% of the taxable income. And finally, any other adjustment specified by the minister. So actually, these are the adjustments the taxable person should apply to determine the taxable income. Now, please, the next slide. Okay, thank you. The exempt income. According to Article 22 of the Federal Decree-Law No. 47, the exempt income is dividend and other profit distribution received from the subsidiary holding a UAE company in the mainland and the free zone. Dividend and other profit distribution received from a foreign company, if the taxable person has participating interest in the foreign company equal to or greater than 5% for a period of at least 12 months. We have also the income derived by a non-resident person from operating aircraft or ships used in international transportation. Also, the capital gain received from the sale of capital assets is exempt from tax, like selling companies' equipment, buildings. On the other hand, gain received from the sale of non-capital assets, like inventory, is subject to tax. We have also the capital gain from sale of a participating interest are also exempt from tax if the participating interests are ownership equal or greater than 5% for a period of at least 12 months. Income derived from intra-group transfers of reorganization is also exempt from corporate tax. For example, two subsidiary companies, A and B. Company A has a business unit and wants to transfer it to Company B. Company B issues a new share to Company A to represent the value of its stock. So if these new shares have a value greater than the shares transferred, then Company A will have made a gain. This gain is exempt from tax. Also, about the resident person who has a foreign permanent establishment, he can make election to not to include the income and associated expenditure of its foreign establishment. In this case, any transfer of assets and liability between the resident and its PE shall be treated as if it took place at market value. Now we're going to talk about the next slide, please. The deductible and non-deductible expenses. To calculate the taxable income, we can categorize expenses into deductible expenses, non-deductible expenses, and partially deductible. In general, expenses incurred wholly and exclusively for business purposes are completely deductible. The non-deductible expenses, I'm going to mention them as they are stated in the law and give an example on some of them. We have here the personal expenses. Of course, it's non-deductible. Expenses derived from exempt income. Losses not connected to primary business. So, for example, a restaurant that owns a rental property and suffer losses on the rental property. These losses are not connected to the restaurant business, so it can be deductible. Donation, grant, gift to non-public entities like private foundation, non-profit organization. Fine, penalties other than amount awarded as compensation for damage or breach of contract. So amount paid by court's order is deductible. Bribe, tax imposed outside the state, dividend and other profit distribution, amount withdrawn by natural person from his business, corporate tax paid, input VAT paid. As for the expenses that can be partially deductible, I'm going to talk about the expenses with dual purposes, entertainment and the interest. In the case of the expenditure with dual purposes, personal and business, a deduction shall be allowed only for the part related to the business. If it's none, if not, an appropriate portion should be taken. The entertainment. The Federal Decree-Law stated that only 50% of entertainment expenditure spent on customer, shareholders, suppliers for business purposes are allowable to determine the taxable income, like meal, accommodation, admission fees, etc. Now we're going to talk about the interest expenditure. Here's the next slide. The law allows the taxable person to make a special deduction or general deduction. A general deduction is allowable for the interest amount that doesn't exceed 30% of accounting earning before the deduction of interest, tax, depreciation, and amortization. The remaining amount can be carried forward for up to 10 tax periods. This general deduction is not applied to banks, insurance businesses, or other regulated financial entities. In their cases, all interest expenses registered in their books are deductible. Businesses with below the threshold to set by the minister is not subject to this general deduction. According now, I'm going to talk about the specific deduction. According to the specific deduction rules, interest cannot be deductible if it is related to loans used to finance the income or revenues shown in the slide. We'll give an example about interest incurred on loan used to finance capital contribution to a related party. So if company A owns 60% of share in company B, and they decide to increase their capital by issuing new shares. So if company B will use a loan to subscribe in the shares of company B, the interest incurred on this loan is non-deductible. So this is, thank you.
Let's bring Pratik, who will ask a few exciting poll questions.
Yeah.
Yes, I have always believed, Mohammed, thank you so much for the opportunity. And I've always believed that the interaction with the audience will solve a lot of queries that people have. I really want to thank Shadi and Sheetal sir for an amazing knowledge sharing, as well as Mr. Munir and Mr. Mohammed to, showcase what we offer. So we will start with quick poll questions. These are tricky poll questions, and we will give 10 seconds to the audience to answer these. And then we will be talking about a bit more on all questions that are covered. So can we have the first poll, please? Who all will be subject to UAE corporate tax? Mainland entities only, free zone entities only, or both A and B, with few exceptions? Five seconds left. Yes, can we have the answer? Correct. 91% of the audience is correct. It is both A and B, which is mainland and free zone entities with few exceptions. So moving on to the second question. Mr. George, working full-time in employment at Casio Limited, is also earning from tax advisory income from freelancing. Will his advisory income be subject to corporate tax? No, as freelancing outside the scope of corporate tax. Yes, subject to certain turnover threshold reliefs. So you have 10 seconds to answer this. We discussed about the threshold release a while back. Few more seconds. Can we have the results, please? 74% say yes, subject to certain turnover threshold release. Very, very important topic here. George may be a natural person, but because he is having an advisory income with a threshold turnover limit that has been described, which is 1 million dirham, he will be subject to corporate tax, but he may opt, that is why the answer is yes, that will be subject to corporate tax, and any income that he earns over and above, the net profit over and above 375 will qualify for 9% corporate tax.
Pratik, this was one of the question also in Q&A, and
Correct.
I hope we have been able to answer this.
Correct. And it is amazing to note that, we have had 34 questions till now in the Q&A segment. which is amazing. That shows that, all are very active and participating. Can we have the third question?
Total 43.9 has been answered by.
Wow.
By us. Yes. Yeah.
The next poll question, please. I have an investment company in foreign jurisdiction, maybe Cayman, Seychelles, which I'm managing and controlling from UAE. Will UAE corporate tax be applicable on this company that I'm managing? Yes or no? I think Shadi very well covered about the foreign jurisdiction and the permanent establishment rules. Few more seconds for the audience to answer. Thank you so much. Can we have the answer? Perfect. 69% of the audience is correct. And it is good to see 133 answers to be registered. So yeah, in our opinion, and we believe that it will be taxable because it is being managed and controlled from UAE, and hence corporate tax will be applicable. Can we move on to the next question? I have a family foundation registered in DIFC ADGM. Will that be subject to UAE corporate tax? Yes, no, both A and B. A tricky question. Few more seconds for the audience. Perfect. Can we have the answer, please?
Wow.
Oh, very, very tight. 34, 32.
Parliament.
Yes. But yeah, it is both A and B, because if the family foundation is performing any activity which is apart from the scope of foundations, which is holding the assets and doing any business activity, that will be subject to UAE corporate tax. So brilliant to the audience who've answered both A and B. And for the others, if there are any doubts, you may feel free to ask questions to this.
In all cases, Pratik, I would like to highlight here that family foundations will have to apply so that it is treated as a pass-through structure. They've used a terminology called unincorporated partnership. So they'll be treated like an unincorporated partnership. So no tax at a foundation level, but tax at the hands of individuals. So in individuals, there is no taxation in you. So effectively the answer is yes and no both.
Correct. Moving on. Yeah, the next question. I work in a company owned by my wife, and I draw salary from the company. Will UAE corporate tax be applicable on my salary income? Yes or no? Few more seconds. And I hope, people are enjoying this poll questions, because it clarifies all the doubts that we may carry. Can we have the answer, please? Wow. 89%. Wow, 144 people and 89% consider it no. So yes, Sheetal sir, can you throw some light on this? Why it is no?
First and foremost, the tax, as I mentioned in our salient features as well, that this is a corporate tax. This is not a tax on individuals. So the salary income in the hands of individuals is not taxable. However, I'm sure a lot of tax professionals here and everybody is planning around it, particularly sole establishment professionals who own, small companies. The money that you take from your own company effectively, because your wife company or your own company as salary, will be subject to, you're more of a connected person. And correct. The transfer pricing rules and the arm's length principle has to apply. So how much deductibility the company will be able to get is a different question altogether. But it is not taxed in the hands of individuals who receive the salary.
Correct. So, and you know, as Sheetal sir said, it has to be in the arm's length principle, and transfer pricing will be applicable, because even in the definition of related party, this is covered. So excellent. Moving on with the next poll question. I think the audience is enjoying it because we have more than 140 participants answering it in 10 seconds. Perfect. Will individual be subject to UAE corporate tax on income from personal investments, that is dividends, interest on bank deposits, rental income from properties? Yes or no? I think pretty straightforward after that, but yeah, would love to see the answer. Can we have the answer, please? No. Perfect. 93% are correct. 7% audience still feels that it will be subject to corporate tax. So natural person, which is individual, obviously on the personal income will not be taxable, and it is out of the purview. Moving on with the next poll question.
But there is one question, related question in Q&A that I have seen, Prateek.
Yeah.
The gentleman seems to be asking that if I own all these properties in the name of sole establishment.
Correct.
So, I mean, it's a tricky question in my view.
Yes.
If you own the property in the name of sole establishment, it will be treated like a business.
Correct.
And it will be subject to corporate tax. It is, you know, if it is held directly in your personal name, then it's a personal investment income, which is not subject to corporate tax.
Hope but in a company format, yes. Yes.
Yeah.
Correct. So moving on to the next poll question. Will rental income on properties be taxable under the UAE corporate tax regime? No. Yes, only for individuals. Yes, only for companies.
A lot of real estate investors in Dubai.
Few seconds more. Can we have the answer, please? Yes, only for companies. So 87% feels yes, it will be applicable, and the income may be taxable to companies. Yes, as Sheetal sir said recently, the rental income in hands of company may be treated as business income and can be taxable under the UAE corporate tax. Moving on with the next poll questions. I think with the poll, the question answers also are increasing. We have reached 50 question and answers, which is exciting. And just for the larger audience, these questions will be answered while the presentation is on by the panelist itself. And stay tuned till the end for all the answers that we may have to all the questions.
If we are not able to answer, we'll share the answers to you separately.
Correct. Will our DIFC ADGM registered fund be taxable under UAE corporate tax regime? Yes. No. No if certain conditions are met. It's a fun question, a tricky one. Can we move on to the answer, please? 75% people feel yes, it will not be taxable if certain conditions are met. Yes, you're correct. If the conditions are met in terms of fund, because it is a pass-through structure, if there are no other business activities apart from the structure mentioned, definitely UAE corporate tax will not be applicable on the fund. But the investment managers who are managing it, they may be under the purview of UAE corporate tax. Moving on. Will dividend income from UAE entities be taxed in the hands of companies? I repeat, will dividend income from the UAE entities be taxed in the hands of companies? No. Yes. Few more seconds. Perfect. Thank you. Can we have the answer? Wow. This is 50-50. 136 people and 68 say no, 68 say yes. So I would like Mr. Sheetal to throw some light on this as well, because this is a hot topic, and dividend income from the current UAE entities. The question is very straightforward. From UAE entities will be taxable or not?
The answer is no. See, dividend globally, dividend income is, if we tax the dividend income, it's considered as double taxation, because, dividend the companies distribute after, assuming that after paying certain taxation already at a company level. So, however, we have asked this for UAE entities, but when it comes to foreign entities, the answer might have changed a bit, right? Because then there are certain participation exemptions that you get, but otherwise up to a nominal 5% holding, your dividend income earned in a foreign entity is subject to tax. But as far as UAE entities are concerned, dividend incomes is out of the scope.
Correct. I think Mr. Sheetal has taken the next question itself, but
Oh.
Can we have the next poll question? Yeah. So will dividend income from foreign entities be taxed in the hand of companies? So like it mentioned, it is yes, subject to participation interest exemption. So I hope, this polls and these questions clarified a lot of doubts. We will move on. Can we end the poll, please? And see what people have answered. %, yes, subject to participating interest exemption. Correct. So moving on, we will have some more informative knowledge sharing session from the other panelists, and I'll see you in a bit for another round of poll questions. Over to you, Mohammed.
Thank you very much, Pratik. Before we move on to Karishma, is there any chance we have Doha again? Let's try. Doha, can you hear us?
Yes. Hello, Muhammad. Sorry, I had a bad connection, so I'm back.
Okay. Do you want?
Still, the voice is not clear, Mohammed. I feel.
What?
Still, it is not clear. What do other people think?
It's not clear now.
Let's try.
Can you hear me?
I can hear you very well.
Okay, very good. Okay. We will back to our topic about adjustment. The adjustment, yes. Okay, thank you. We will talk now about.
Thank you very much. And now we will move to Karishma.
Thank you, Doha. Thank you, Mohammed. I would like to explain about the tax groups, the qualifying group, the business restructuring relief, the tax losses, and the general anti-abuse rules, as well as the administration and audit under the UAE Corporate Tax regime. Now, very first, coming to the tax group. Under the UAE Corporate Tax regime, the law has specified and given the benefits for the tax group they can form a tax group, and subject to such conditions and fulfilling on those conditions, they can get certain benefits. What are the benefits? We will get to know in the later part. Very first, let me explain you what are the conditions to form a tax group. Now, if you are a resident person, then you can be a part of a tax group. That means if you are a permanent establishment or there is a branches of the foreign company in the UAE, then it cannot be a part of the tax group. Secondly, any juridical person can be part of the tax group. That means the natural persons or the unincorporated joint ventures are not eligible to form a part of the tax group. The most important condition while forming a tax group is the parent-subsidy relationship. If the parent hold at least 95% shareholding or the voting right of the subsidiary, or the parent has at least 95% of the net assets and profits of the subsidiary, then it can be part of the tax group. Neither of the company, that is the parent or the subsidiary, is a qualifying free zone person and both the parent as well as the subsidiaries follow the same financial year and use the same accounting standards to prepare their financial statements. If all these conditions are fulfilled, then the parent and the subsidiary or its associated concerns can have and form a tax group. Now, to explain further, like which companies can be part of the tax group or which cannot be a part of the tax group, let me walk you through this basic examples. Suppose in scenario 1, you can see that H company holds 98%, 97% and 75% in each A company, B company and C company. All are located in the mainland. In such scenario, H company, B company and H company, A company and B company can be part of the tax group. However, C company would not be eligible to form a part of the tax group, that is, as H company is holding only 75% of the voting rights or shareholding of the C company. Coming on to the second scenario, where you can see that H company, A company and B company are located in the mainland with 98% and 97% shareholding held by H company in both of these companies. And although 99% of the shareholding is being held by H company and C company, but as it is located in the free zone, it cannot be a part of the tax group. So these are just the basic example to get you understand that which companies can be part of the tax group based on the conditions which are being given as per the UAE Corporate Tax Law. Now, every coin has two sides. Similarly, forming of a tax group also has its own advantages and disadvantages. Let me quickly walk you through what are the benefits or what are the advantages of forming a tax group. The first and foremost advantage of forming a tax group is there will be a single registration, there will be single written filing and single audit for all the companies as a whole. Hence, there won't be multiple audits, multiple registration for each individual entity of the tax group. Secondly, as it is forming an entire tax group, there will be just one consolidated financial statements which needs to be submitted as and when asked. And the most important and impressive benefit that is being given to the tax group is about the related party transactions. So if a company's parent or subsidiaries form a tax group, then there would be some leeway, there would be some of the lower degree of scrutiny that will be applicable on them as per the transfer pricing laws. So if there are any intra-company or intercompany transactions between the parent and subsidiary, then those transactions would not be subject to or would be lesser subject to the transfer pricing regulations. Coming on to the disadvantages. The major disadvantage of forming a tax group is the basic exemption. The basic exemption threshold, that is 375,000 dirhams, will be applicable to a group as a whole rather than each separate individual entity under the tax group. Secondly, it is limited to only the parent and subsidiary relationships, as it will be restricted to only those business structures. Thirdly, it will trigger a joint and several liability on the parent and subsidiaries. And most importantly, whenever there are any mergers and acquisitions, demergers or any such kind of dealings, there will be potential complications that might be involved in such structure. Now, just to give you an idea, like tax group, when formation of tax group, when it will be beneficial for the companies, I would just walk through those very simple examples. Suppose company A and company B, as you can see on the screen, has a net taxable income of 2 million and 1 million respectively. If the companies opt to file their corporate tax return on an individual basis, then the tax liability comes to 146,000 and 25,000 dirhams, whereas company B has a tax liability of 56,250, which comes to the total liability of 2,02,500. If the company opts to form a tax group, then the entire taxable income of the company comes to 3 million, and after applying the threshold of 375,000 dirhams, the tax liability comes to 2,36,250. So in this case, you can see if both the companies are profit making and they form a tax group, then instead of lowering the tax liability, it is as such increasing the tax liability. So in such cases where both companies are having a profit making companies, it is not advisable or not viable for the companies to form a tax group. Moving on to another example, under similar situation, if company A has a net taxable income which is actually negative, that is 0.5 million, and company B has a revenue of 1 million, And individually, if they file their corporate tax returns, then the tax liability will be 56,250 after applying the basic exemption threshold. But if they apply and elect to form a tax group, then the entire income of the tax group becomes 0.5 million, and after applying the tax exemption of 375,000 dirhams, the tax liability of the company reduces to 11,250 dirhams. So you can get a very clear idea in such scenarios that where a company or has a combination of profit or loss making entities, it is advisable or it is optional, viable for them to form a tax group just so that they can have a proper tax liability calculated. Moving on to another important aspect under the corporate tax regime, that is a qualifying group. Firstly, I explained you about the tax groups. So tax group is usually beneficial for the companies where there is a parent subsidiary association, where there is such kind of relationship coming into picture. But under other circumstances, it sometimes may happen that there is a transfer of assets or liabilities between the companies who doesn't hold more than 95% shareholding in their companies. So in such cases, under the corporate tax regime, there is a qualifying group exemption given. So if the members are the juridical person, they own more than 75% of each other, or the third party owns at least 75% in both the companies, neither of the companies is an exempt person or a qualifying free zone entity, and they prepare the financial statements using the same accounting standards and have the same financial year, then in such cases, if there is a transfer of assets or liabilities between these companies, then no loss or gain on such transfer would be taken into account while calculating the taxable income. This means that they get a benefit, and that capital gain, as explained by my colleague earlier, Doha, that such capital gain would not be taxable in their hands. But if after 2 years or within 2 years of such transfer of assets and liabilities, there is a subsequent transfer, or any of the members cease to be part of the qualifying group, or any company holds less than 75% of the shareholding, then in such cases, the exemption which was given earlier may be withdrawn, and it will be taxable in the hands of both the companies, the transferor as well as the transferee, at the market value which was existing at the time when the assets or liabilities were sold off. Under the same structuring given for the tax group and the group relief, under the qualifying group, another example which comes is the business restructuring relief. Many times companies do sell off to sell their businesses, or there is an acquisition, or there is a merger or demerger. Under such cases, based on the conditions which are given for the qualifying group, except for holding more than 75%, if these conditions are fulfilled, then any transfer of assets or liabilities between these two taxable persons would also be exempt from the corporate tax regime. That means those assets or liabilities transferred will not form part of the taxable income of the group. Another important aspect under the corporate tax regime is the tax losses. Now, many of the questions I can see in the Q&A session as well, people have been asking that what about the tax losses which is incurred prior to the corporate tax regime? So let me make it very clear. Any tax losses which is incurred prior to the corporate tax regime, that is before 1st June 2023, you won't be able to claim that in your future tax periods. Logically speaking, if you're incurring any loss prior to the tax losses, it is not allowable to be carried forward. Also, even if may happen that your company is becoming is not a taxable person for the first year of applicability of corporate tax. Maybe you became applicable in 2024, but there was your loss in 2023. You cannot even carry forward the loss of 2023 to 2024. So basic criteria is, unless and until you become a taxable person, you will not be able to carry forward any of your losses to the future taxable periods. Also, very important and highlighting part about the tax losses is you can carry forward it to unlimited period of time. That means there is no such time limit that you can carry forward your tax losses. However, it is only subject to one condition, that is only 75% of the taxable income can be allowed as carry forward and set off of the losses. Other than that, you can carry forward all your losses. Also, the another important criteria while transferring your losses to the subsequent tax periods is 50% of the common ownership must be maintained in the beginning in which the loss was incurred till the end of the tax period. Also, similar or somewhat same kind of business activities must be followed by the businesses since the loss was incurred till when it wants to set off those losses. Interestingly, the tax losses and this 50% common ownership about the carry forwarding about the losses is not applicable to a taxable person which is listed on a recognized stock exchange. This brings me to a very important and a very scary part about the corporate tax regime, that is the general anti-abuse rules. Now, many companies, since this corporate tax have come into the picture, have started building about their own planning, that how we can reduce the tax, what are the ways we can have it. So let me make it very clear. If you are planning anything like that, there will be the anti-abuse rules applicable, and these companies can be heavily penalized. So there are many ways that you can have, like you want to have a tax refund, or you want to increase your tax refund, you want to avoid tax, or you want to defer tax. Any of such situation, these are just few examples that I'm trying to give you. If the business is trying to defer or to reduce their corporate tax liability or find a way out, then there is anti-abuse rules applicable and there will be heavy fines. Let me explain you this with a very simple example. Suppose in the year 2023, X Limited had a revenue of 5 million with taxable income of 780,000 and its corporate tax liability comes to 36,450 dirhams. If to avoid this corporate tax liability, X Limited splits its company into X Limited and Y Limited, showing a revenue of 2.5 million and 2.5 million in each of the companies, then as per the small business relief as explained by my colleague Mr. Shadi earlier, they can claim a small business relief. If they opt for a small business relief, then there won't be any tax liability on such companies. Under such situation, X Limited can come on X Limited, the general anti-abuse rules might be applicable and there might be heavy fines and penalties. The fines and penalties have not yet been described, but yes, if you try to transfer or to have such kind of situation, then definitely anti-abuse rules will be applicable. Now, any law, if you want to do the tax registration, if you want to file the return, then there are certain criteria for it. So as per the corporate tax law, every taxable person, may it be mainland company, may it be free zone company, whosoever is applicable, whosoever has a registered license has to mandatorily get registered and file their corporate tax return, except for the small business relief, which was earlier explained that they don't need to have a mandatory registration. I can see in Q&A session, many people have these questions. What is the last date to register? When do we register? Is there any timeline to register? So let me explain you that as per the recent decision which came out, right now only the mainland companies and the public joint stock companies have been required or mandatorily required to get registered. For the free zone entities, the law and regulations are yet awaited. Hence, there is no requirement for them to register right now. And also the companies with financial year with July to June are mandatorily required to get registered within the due date. For rest companies, there is no time limit as such, but yeah, it's always sooner the better to get registered. And secondly, if you anyway want to get deregistered your company, then you have to apply to the authority. What are the forms, what are the documents and all required to be registered? They are yet to be prescribed. There are some basic documents which needs to be done. In that way, we can help you out. Once you come into the corporate tax purview, you have to maintain your financial records for at least up to 7 years as per your official address. You have to self-assess your corporate tax return, and in any time, if you are violating any of the corporate tax laws or regulations as prescribed, there will be heavy fines and penalties. The fines and penalties are yet to be declared by the authorities. Lastly, coming on to a very important topic is about the audit. As per the recent decision of the ministry, it has been specified that the taxable persons which has a revenue exceeding 50 million and a qualifying free zone person are mandatorily required to get their books audited as per the respective laws and regulations applicable to them. With this, I would like to end my topic, and now I would like to hand over to Lara to explain further about the tax residency.
Okay, thank you so much, Karishma. Hello, everyone, and welcome to our presentation. Today, I will be clarifying the latest update on UAE tax residency. So, you want to get a tax residency in the UAE? Then this is for you. The UAE Ministry of Finance has issued the decision number 27 of 2023, defining the new determination for tax residency for both legal entities and individuals. This new law is aligned to internationally recognized standards and in respect of any bilateral tax agreement between the UAE and other countries. So both countries can agree on who is a resident of what country. For legal entity, when is it classified as a tax resident? If it's incorporated, formed, or recognized within the UAE. Hereby, branches of foreign entities are excluded or considered as a tax resident in accordance with the tax law of the UAE. What about natural person? 90 days are enough to make you a tax resident. Actually, to be considered as a natural tax resident, you should have your primary place residence, moreover, your center of financial and personal interest in the UAE, or be physically present in the UAE for at least 183 days during a consecutive 12 months period, or be a UAE or GCC national or holding a UAE visa residency, plus having a primary place of residence or carrying out an employment or a business in the UAE, in addition of being physically present in the UAE for at least 90 days during a consecutive 12 months period. So, UAE residents can apply to the federal tax for a tax residency certificate. Having the certificate will help you to have an absolute clarity about your tax residency position within the country and avoid double taxation. Are only full days spent in the UAE counted? All days or part of days spent physically in the UAE will be counted. Days spent in the UAE don't need to be consecutive. Days spent in the UAE due to exceptional situation could be disregarded from the counting. What about your permanent place of residence? It could be a room, an apartment, or any other form of dwelling place. It should be continuously available for you. It could be owned or rented. Business occupation. Carrying out an employment or a business in the UAE. The employment can be limited or unlimited, and the work could be in a full or part-time basis. Notice, volunteers' roles aren't classed as employment. Carrying out a business in the UAE. When you are carrying out any activity regularly on an ongoing and independent basis, like industrial, commercial, agriculture, professional, service, or any activity related to the use of tangible or intangible properties. And that brings us to the end. If you have any more questions, I will be happy answering them in the Q&A session. Over to my colleague Shadi. Thank you.
Thank you, Lara. Good afternoon, everyone. In continuation to what were presented by my colleagues, now I will touch on other important topics, free zones and transfer pricing. There are around 47 free zones in the UAE that are set up to attract foreign investment by offering various incentives and benefits. One of these benefits now is the 0% corporate tax rate. And they are designated geographic areas which typically located near airports, seaports, and other transportation hubs that are designed to facilitate international trade and commerce. Let us see who are considered free zone persons. Relevant to Article 18 in Corporate Tax Law, juridical persons, including a branch of UAE mainland or foreign juridical persons that are formed or registered in a free zone or otherwise registered, which means here transfers its place to a free zone, will be enabled to benefit from the 0% corporate tax rate on qualifying income only. Important thing to know that UAE corporate tax treatment will be the same for all free zone entities in the UAE. In order to be considered a qualifying free zone person, there are 4 conditions. First one, maintain adequate substance in the UAE. What's the mean adequate substance? It is directed and managed in the UAE. The entity in the UAE is directed and managed. It has adequate employees. It has adequate space. It possesses physical assets and incur adequate and appropriate expenditure. Second condition, derive qualifying income. Third one, not have made an election to be subject to corporate tax at the standard rates. And the fourth one, comply with transfer pricing requirements under corporate tax law. And we will explain more ideas about this in the next topic. I chose some important notes to the free zone person from the corporate tax law and other related decisions. If a qualifying free zone person fails to meet any of the conditions that I mentioned, the 4 conditions, they will be subject to standard rates of corporate tax from the beginning of the tax period. If a qualifying free zone person make an election to be subject to the regular corporate tax rate, also he will be subject either from the first day of the tax period or the beginning of the following tax period, as he include in his request that is submitted. Another point about the tax incentive period for qualifying free zone person or the extended period is that shall not exceed 50 years. For the qualifying free zone person, there are some limitations. Qualifying free zone person can't be one of the members of the qualifying group, which explained by my colleague Karishma. Can't be a member or one of the members of the tax group. Also, free zone person can't transfer his tax loss to other taxable person or to offset against the taxable income of another taxable person when certain conditions are met. We received many questions about free zone person if he is subject to corporate tax or not, or if he must register or not. Free zone person must register for corporate tax. According to the new decision about the registration, now it is postponed, but he is subject to the corporate tax and he must register at a later date. And also, free zone person must file a corporate tax return, irrespective of whether they are qualifying free zone person or not. So free zone person is not exempted. Free zone person is subject to corporate tax at a rate 9% on non-qualifying income, like any other taxable person in the mainland of the UAE. And he will not be able to benefit from the 0% tax threshold. We see that taxable person in the mainland can benefit from the tax threshold up to 375,000 dirhams. But free zone person, every income, he will be subject to corporate tax if it's not qualifying income. It's subject to the rate 9% directly.
Sorry, Shadi. They are asking if you can elevate your voice just a little bit. Thank you.
Okay.
Thank you.
According to ministerial decisions that are issued a few days ago like Ministerial Decision number 73, free zone person can't claim small business relief unless the qualifying free zone person has made an election to be subject to the standard corporate tax rate. And according to the Ministerial Decision number 82 about the requirement to prepare and maintain audited financial statements, free zone person is required to maintain audited financial statements like the taxable person who derive income exceeding 50 million dirham. So here, from these decisions, we can conclude that there is more focus from the Ministry of Finance in the UAE on the free zone person. So take care. Let us jump directly to transfer pricing, which is the one of the most important topics in taxation nowadays and around the world. In the UAE, the commitment to transfer pricing began since June 2018, the date of signing the multilateral convention to prevent base erosion and profit shifting. This MLI of BEPS project entered into force for the UAE on 1 September 2019. By viewing this project, we find that 15 action plan has been launched by the OECD. 4 action plans refer to the transfer pricing. Here we see that the importance of transfer pricing worldwide. Transfer pricing refers to the practice of setting prices for goods, services, or intangible assets that are transferred between related parties or entities. Transfer pricing applies to domestic and cross-border arrangements. The goal of transfer pricing is to ensure that the prices are set at arm's length principle, meaning that they reflect the market value, and also to ensure that the profits are taxed where economic activities are performed and value is created. For sure, we talk about transfer pricing rules means that to meet the arm's length standard, and this happens when the results of the transaction or arrangement between related parties are consistent with the results between non-related parties under similar circumstances. Transfer pricing rules are applicable also to intra-group loan arrangements as well, as any loan obtained from or granted to related party or connected person need to be at arm's length regarding the interest rate or the duration or the repayment period. Transactions in tax group need not comply with transfer pricing rules unless a member in the tax group computes his stand-alone taxable income, because the transaction between the members in the tax group can eliminate it. So we have 5 methods for the arm's length principle: the CAP method, comparable and controlled price method, the resale price method, the cost plus method, the transactional net margin method, the transactional profit split method. These methods can be applied for the arm's length principle. If the results of the transaction or arrangement between related parties doesn't fall within the arm's length range, what will happen? Here, the authority plays the role. The authority shall adjust the taxable income, relying on information, and at the same time, either the authority or the taxable shall make a corresponding adjustment to the taxable income of the second related party. So the adjustment is for both domestic parties. The tax authority can make adjustment for the taxable income for a seller. Also, this is reflected for the buyer at the same time. Where a foreign competent authority makes an adjustment to a transaction or arrangement involving a UAE taxable person to meet the arm's length standard, such taxable person can make an application to the FTA also to make a corresponding adjustment to his taxable income. On the slide, we can see the related parties and connected persons. Of course, there's a differentiation between them. There's a difference. Connected persons such as the owner of the business, the director, the auditor, while the related parties, individual relatives, 50% or greater ownership interest directly or indirectly in a juridical person, controls directly or indirectly in a juridical person. Let us see the transfer pricing documentation. According to Article 55 of Corporate Tax Law, there are requirements of the taxable person. First one, the disclosure form. Disclosure form of the transactions and arrangements with the related parties and connected person should be filed together with the tax return. This for any taxable person. Second requirement is to maintain both a master file and a local file. Here, to maintain this document, there are conditions according to the Ministerial Decision number 97, which was issued a few days ago. First one, it is for the taxable person revenue in the relevant tax rate that exceeds 200 million dirham. And the second one, the taxable person is an entity of a multinational company, which total consolidated group revenue shall exceed 3,150 million dirham. These two kinds of taxable persons required to maintain master file and local file. And the transfer pricing documentation, which is about the master file and local files that are required to be maintained by the taxable person, must be submitted to the authority within 30 days following a request by the authority. If we enter in more details about this ministerial decision, we find that there are some transactions and arrangements with related parties and connected persons included in the local file and excluded from the local file, which are shown in the slide. And I don't want to take more time. Thank you, and hope that everything is fine with all of you.
Thank you very much, Shadi. Let's go back to Pratik for a few more poll questions.
Thank you so much, Mohammed. Before I start the poll questions, I think our board advisor, Mr. Ala, is here, and his words of wisdom will be very fruitful for all of us. So over to you, Mr. Ala, before I start the interesting poll questions.
Well, I'm very sorry, but as you know, I'm in Lebanon, and the electricity switched off at the time of the beginning of the webinar. All I want to say is we have here in MI Capital and MI Capital Advisory Services a very dynamic and professional team, which will be happy to help all potential clients in the UAE and the region in, first of all, trying to help them in their tax, income tax affairs, as well as in other financial advisory services. And I'm sure we have, or we are able to demonstrate that we know our stuff, and we have a capable team to really service our clients for their continued success. My apologies again for being late.
Thank you so much, Mr. Ala. As you said, you know, we are MIC Tax Services as well as Technology Services, and technology is growing with time, and that is how we are connected to more than 200 people, you know, at just one frame. So moving on to some great insight sessions from Karishma, Lara, and Shadi. I would like to take some very witty, good questions for everyone to, you know, just enjoy and get the clarity. And I'm very happy to see that our Q&A box was filled, and the panelists were working very hard to answer all the questions. We've answered more than 100 questions, and if there are any, the Q&A box is still open for your questions. So can we go on to the poll, please? Yeah. So I'm a foreign individual and earn investments income in UAE. However, I do not have any business activity in UAE. Will I be subject to UAE corporate tax? Just to repeat, I'm a foreign individual and earn investment income in UAE. However, I do not have any business activity in UAE. Will I be subject to corporate tax? Yes or no? Yes or no? Can we have the answers, please?
Many foreigners are buying property in Dubai, making it difficult for people like us to rent.
So 90% of the room says, Sheetal sir, it is no. What are your thoughts on this?
Absolutely correct. The individual
Correct.
income in the hands of resident person or foreigner, doesn't matter, is outside review of the corporate tax.
Great. Moving on to the second question. What rate of UAE corporate tax is applicable for qualifying free zone earning qualifying income? 0% or 9%? I think Q&As were filled with such questions, but yeah, just to clarify it, few more seconds. Can we have the answer, please? Wow, 73% say it is 0%, but there are still 27% people who feel it is 9%. So it is very clear, any qualifying free zone entity having only qualifying income will have 0% benefit. Otherwise, it will be out of the purview of 0%, and any income that you earn, which is non-qualifying income, will be taxed at 9%. So if you ask me the definition, only qualifying income definition is yet to come, but I'm sure in the days to come, we'll have that decision as well. Moving ahead to the third poll question. I have a qualifying free zone entity with all qualifying income subject to 0% tax rate. Do I still need to register and file my nil tax return? Yes or no? So a person having qualifying free zone entity, having all qualifying income, do they have to file and register for corporate tax return? Yes or no? Few more seconds. Perfect. Can we have the answers, please? Absolutely. 94% of the audience is correct. They will have to register as well as file the nil tax return. Moving on. The next question. I have a qualifying free zone entity. Can I get the small business relief for corporate tax? Yes or no? A qualifying free zone entity, can it avail small business relief for corporate tax? Few more seconds. Can we have the answer, please? So it is a very close competition. 45% say yes, 55% say no. But if you see the clarification and explanatory guide as well as the law, it is clear that qualifying free zone will not be getting the benefit of small business relief. Hence, the answer is no, it will not get the relief. Moving on. Will branches of UAE entities need to file separate corporate tax returns from their parent entities? Yes or no? Can we have the answers, please? Will branch of UAE entities need to file separate corporate tax returns? 75% say no. Karishma, what do you feel? Is it a no or yes? Karishma, you're on mute. No worries. Yes, we feel that it is correct. You do not have to file corporate tax returns separately from your parent entity. Moving on, will tax holidays continue to apply to free zone entities? Yes, subject to maximum 50 years. No. What are the tax holiday benefits for free zone entities? Few more seconds. Can we have the answers, please? Correct. Yes, it will be subject to maximum 50 years, which is clarified. 79% of the room is correct. Moving on. While calculating taxable income, can I deduct all business and personal expenses from my business revenue? A question, a lot of questions in the Q&A had this. So only business expenses are allowed, only personal expenses are allowed, or both personal as well as business expenses are allowed? I think this was covered very well with Doha. Can I have the answer, please?
Yes, of course. Only business expenses can be deductible. The personal cannot be deductible.
Perfect. Can we see what the room has answered? Can we go to the results?
Karishma, can we go to the results?
Yeah. Perfect.
Ah,
88% of the room.
There is somebody who's very wishful here.
It's only person.
Moving on to the next question. In my business, I have a positive EBITDA. However, net profit is almost nil due to significant interest cost. Do I still need to pay UAE corporate tax? No, possibly yes. I repeat, my business has a positive EBITDA, but the net profit is almost nil due to the significant interest cost. Do I still need to pay UAE corporate tax on it? No, possibly yes. Very, very important subject. Can we move on to the answers? Yes, you're correct. 68% of the audience is correct. Possibly yes, because there is a 30% cap that you have to maintain for the interest cost that is allowable. So very well done. Moving on to the next question. Can a parent company file one single UAE corporate return for all the companies it owns in UAE? Yes, if the company chooses to form one single tax group meeting all the conditions. No. Few more seconds. Can we have the answer? Yes, it is correct. 99% of all of you are correct. Yes, if the company chooses to be one single tax group, they can file one tax return. Can we go ahead? Yeah,
Pratik, I think on this point, there were few queries even in the Q&A when certain people were asking, if I as an individual own 5 companies, can I make a tax group of these 5 companies? And the answer to that question is no. The tax group can only be formed if the parent company is a holding company, it's a juridical person rather than an individual. However, you can claim the benefit of transfer of losses through other provisions, but tax grouping you cannot do. Hope this clarifies.
Correct. Moving ahead, my family owns and controls multiple companies, and there are intra-group transactions, including intra-group companies in the intergroup companies of loans. Do I need to comply with transfer pricing rules? Yes, no. Few more seconds. Can we have the answers? Yes, 93% of the room is correct. The transfer pricing has to be adhered to, and the intra-group companies, the loans that have been done has to be an arm's length principle. Moving ahead, I run a startup which is expected to remain in losses for the first 3 years, will I get benefit of carry forward of losses in future years when we start making profits? Yes, subject to certain restrictions. No. I think there are a few startup business owners here as well, so they would enjoy this question. So startup which is expected to remain in losses for first 3 years, can they get a benefit of carry forward of losses? Can we have the answer? And see what the room has said. Correct. 94% of the room is correct, with certain restrictions, that is 75% of the cap, you will be able to carry forward the losses. Moving ahead. The parent company owns 10 companies and they qualify to form a single tax group for all the companies. Do they get the benefit of 0% tax on up to only AED 375,000? Or the 0% threshold will increase to 3.75 million, considering 375 in each entity. So what do you think? 0% threshold on AED 375,000 or 0% on 3.75 million? A tricky one. Few more seconds. Perfect. Can we have the answer? Very well explained. 86% is correct. It is going to be a single tax payer, so it's going to be 375,000. I think 14% of the room is still wishful that it'll be 3.75 million. So no, it'll limit itself to 375,000. Moving ahead, can we have the next question? Can foreign entities be included in a tax group? Yes, no. Can a foreign entity be included in a tax group? Let's see what the room has said. %25% still hopes that it can be part of a tax group, but yeah, foreign entities cannot be included in the tax group. So 75% of you are correct.
Pratik, it's worth clarifying here. Forget about foreign entities. Even a qualifying free zone entity cannot be part of the tax group.
Correct. Correct. Moving ahead. Company registered in a mainland having revenue of 49 million dirhams. Do they need to get the books audited? Yes or no? In the administrative and the recent amendments that Karishma had touched upon, we had discussed this. So any company registered in mainland having revenues of 49 million dirhams, do they need to get audited? Yes or no? Can we see what the room has said? Yes, 38% feels it is yes, and 62% says it's no. So ideally, we would recommend that you maintain your financial statements and get your books audited. But yeah, there is a cap of 50 million dirhams that has been announced. And so it is correct that 49 million dirhams can avoid getting their books audited. But it is recommended that you get the financial statements ready and get audited. Yes, Sheetal sir.
No, I was just saying that, yes, there is a relief. However, FTA may ask you to get your books audited, even if it is less than 50 million. So there is a relief that you don't necessarily need to maintain it, but they can ask for it as well.
Correct. Moving ahead. Does a company need to register with FTA for UAE corporate tax even if the company is dormant with no business transaction for the financial year? So a company which is dormant and having no financial year, no transactions in the financial year, do they need to register with FTA for UAE corporate tax? Yes or no? Very important. Let's see what the room has said. Can we see the poll answers? Correct. 73% of the room is correct. You do still need to register for UAE corporate tax.
I think this was also one of the dominant question in the Q&A. Somebody asked, somebody was confused as well, right? While that some of the slide was saying that, it does not necessarily need to be registered. But that slide, if I recall it correctly, was related to individual doing business without registering an entity. So if an individual is doing a business without registering an entity, up to 1 million, there is a relief. Over and above 1 million, they need to register. But all entities, whether dormant or doing business, having no transaction, whatever, are required to be registered for UAE.
Correct. Do I take the remaining questions as well? There are a few more interesting questions. So it's upon.
Yeah. I think Pratik, there are about, there are more than 120 participants here. Go ahead with the questions.
Perfect. Can we have the next poll question? Do I need to register my company with UAE corporate tax separately, even if I'm already registered for VAT? Yes or no? Is registration mandatory for UAE corporate tax, even if you have a registered for VAT? Can we see what the room has answered? Can we go to the results, please? Karishma, friends. %91% of the audience is correct. Yes, you do need to file for separate corporate tax registration, because as clarified, FTA has VAT is very different and corporate tax is different. So separate corporate tax registration has to be done. Moving ahead. How often I need to file the UAE corporate return? The corporate tax return has to be filed annually, quarterly, or both annually and quarterly. Few more seconds. Perfect. So 3% of the audience still feels it is quarterly. Yeah, but just to clarify, it is annually and it has to be filed once. Can we go ahead? I deal in various currencies. In which currency I need to file UAE corporate tax return? USD being widely accepted global currency, AED, or both? Mr. Munir, you have a smile. So I think, you would want to speak about this.
No, but I think logically it's in the currency of the country.
True.
Perfect. True. Yes, it has to be filed in AED. Can we see what the room has answered? Still. 96% of the room. Yeah. So there is one person in the room who wants to file in dollars, and there are two people who are okay with both. Going ahead. Company with revenue of AED 215 million in a financial year needs to maintain transfer pricing documentation. Yes or no? I think Shadi covered it very well and summed it up very well when it comes to transfer pricing. I'm hoping that we get 100% on this. Can a company with a revenue of 250 million AED in a financial year has to maintain transfer pricing documentation? 85% of the room is correct. Yes, you do have to maintain the transfer pricing documentation if your turnover is 250 million dirhams. Moving ahead. Last few poll questions, I feel. A freelancer doing accounting and advisory services, earning revenue of 500,000 dirham in a year, is it required to register and file the corporate tax return? Yes or no? A freelancer doing accounting and advisory services, earning revenue of 500,000 dirhams in a year, required to register and file for corporate tax returns? Yes or no? Can we see what the audience have answered? It's a tricky one, 43% and 57%. So yes, I would like to clarify that they do have a relief of 1 million dirham, which has been answered by us a while back as well. So 500,000 dirhams can be away from registering as well as filing of corporate tax return. What should I do? What should I be doing to prepare for UAE corporate tax? Should I sit and do nothing, or understand its impact on my business and plan it for efficient compliance? Mohammed, what do you feel? What should we do? Mohammed?
Yes.
What should we do? Should we do nothing, or should we understand the impact and plan it efficiently?
We should understand its impact on our business.
Perfect. Can we see what the audience has
Sorry,
said?
Mr. Pratik.
Yes. Yes, Shadi.
I want to give an advice here.
Sure, please go ahead.
Shadi, we are in business of giving paid advice.
Yes.
Anyway, go ahead.
If any one of us has a headache and he wants to remove this pain, what shall he do? He goes to the doctor and takes the medicine, isn't it?
Correct.
But now for tax headache, I want to give an advice for all of you, anyone who listens to me. Go to MI Capital and you find the medicine there. And you find the best treatment there and a solution for any complex case of taxes you will face. Thank you.
Correct.
There is one comment in the Q&A: do nothing but hire MI Capital.
Can we have the last poll question? I think that is an interesting one as well. Are there any consequences of not complying with UAE corporate tax laws? I'm sure all of us, in the panelists have read this law, the explanatory guide. So are there any consequences of not complying with UAE corporate tax law? What the room has to say, yes or no? Can we see what the room has said? Karishma, Prince? 8% are still hopeful that there are no consequences. But unfortunately, there will be consequences of not complying with UAE corporate tax, and it will be defined very soon. But there will be consequences. So it is best that before few days, I think it's just 5 days, we are away from the applicability of UAE corporate tax. And it'll be best if we get ourselves aligned, if we start getting into the groove. As mentioned by all the panelists, it is just 9%. So we should get it done, and we should obey the 9% tax guidelines, because it is still one of the most efficient place to do business. Over to you, Mohammed. Thank you so much for giving this opportunity to asking these questions.
Thank you very much, my friend Pratik. I will now hand the floor to Munir for the closing note.
Well, after everything that we've heard today, I hope it has been useful to everybody. I would like to end this webinar by thanking you all for your invaluable participation. We had an impressive attendance, over 200, I think. And this very high number of participants is surely a clear indication of the interest that there is today in the very hot subject of corporate tax in the UAE, which concerns everybody. So also I would like to thank all my colleagues, the MIC Tax and Technology Services team members who have decades of experience within the tax administration and who have demonstrated a lot of really talent and expertise in explaining all these aspects of the tax law. However, our intention was to give you an overview on the tax regulations and to enlighten you on the upcoming challenges, hoping that you found all this useful and informative, although for the time being, really you should look at it as no more than a teaser to take us through this transition into the new tax regime. So I'd like also to thank you for your interactive participation in the poll questions. I'm sure you have found them very interesting and interactive. Really may not have precise or definitive answers as yet, as long as the regulations and the decisions from the Ministry of Finance continue to be issued piecemeal and progressively. It is needless to reiterate that the ultimate and only authority on the source of information for ruling on final decisions on all tax issues and questions is the Ministry of Finance and the FTA. Our role as tax advisors and consultants is limited to provide guidance and help navigation through the different complexities of the regulations. So our most important advice to you now, as we embark on this transition, is to gear up for all the needed transformational measures to upgrade your IT and ERP and accounting systems so that you can remain compliant with the new regulations and be well prepared for the forthcoming engaging period. MIC Tax and Technology Services is your perfect partner and advisor and consultant because it has the edge. It has the edge as a one-stop shop covering this multitude of tax advisory, ERP, IT, and cybersecurity, and also digital transformation services. So it's a one-stop shop for all these services under the same roof. And so we urge you to follow us in our forthcoming webinars and to contact us for advice and implementation. And we will certainly be thrilled to accompany you and be by your side in all our future operations. Thank you very much. Hope to see you soon. But before you leave, we'd like to invite you to stay on for the general Q&A session coming up right now. Over to you, Mohammed.
Thank you very much, Munir, for these remarks. Since I believe we have covered most of the poll questions in the Q&A box, and that it's now you've been very patient for over 2 hours with us. We will leave it here, but however, we want to thank you again for attending our webinar, and also please stay tuned as we will be announcing another webinar soon where we will try to explain all the materials shared today with concrete examples and case studies. Thank you, everybody, and have a great evening.
Mohammed, I would like to read one comment, and thank you, Mr. Sushant Chaudhary, for writing this beautiful comment for us. It's worth the effort, it seems. Sushant is writing here, attended few webinars so far. This was the best that he has attended so far. So thank you, Sushant, and thank you for all the beautiful comments that you have wrote. And we have tried to answer all the queries. Still, if you have any query at any point of time, feel free to write to us, and we will come back to you.
And just to add, we will be sending this presentation via email to all of you who have registered. So if there are any questions, feel free to reply to that email, and we'll be getting back to you. Thank you. Thank you so much.
Thank you very much, everybody.
Thank you. Goodbye.
Thank you.
Bye-bye.
Goodbye. Goodbye.
Thank you.
Thank you. Goodbye.